As the S&P 500 plunged over 38% in 2008, gold quietly climbed 5%. And in 2020, when COVID hit, it ripped to fresh highs while stocks cratered. Then in April 2025, as Trump-era tariff fears resurfaced and equity markets sank nearly 20%, gold surged to a new all-time high. You might think there's no clearer get-rich signal than that glittery metal, but before you swap your retirement fund for bullion, there's a twist you need to hear. Over millennia, gold has been more than just jewelry or coins. It's been government's go-to safe haven when currencies falter. But that ancient pedigree doesn't automatically make it the perfect anchor to your portfolio. To decide if gold belongs in your wealth plan, we've got to dig into its true strengths, its hidden costs, and the strange ways you can actually own it. Because the way you invest can turn gold into either a fortress or a money pit. And later, we'll uncover a surprise about digital gold that could change everything. Why gold became king. Imagine you're in Rome, 50 BC. Paper money doesn't exist, but a gold coin buys you a meal, a room, even a legionnaire's loyalty. Now fast forward to the 1970s, when inflation hit double digits and gold surged again. Because every time governments crank money printers, gold's price tends to rocket. It's not just sentimental. Between 2000 and 2020, gold averaged roughly 8% per year, and in crises its value often spikes, even as stocks gasp for air. But here's the catch. Despite a solid long-term track record, gold isn't what you'd call a pure growth asset. Most of its upside comes when the world is falling apart, not when economies are booming. So if you crave consistent double-digit growth, you'll need more than a bullion bar. Yet that begs the question, how do you actually buy gold today? Stick around, because the next section will lay out your 4 very different paths, and one of them might surprise you. Physical gold, coins, bars, bullion. Pros: no counterparty risk. You own the metal outright. Tangible asset. It's physical and universally recognized. Private and off-grid, can be held outside the financial system. Cons: storage and insurance costs. Safekeeping adds ongoing expense. Liquidity friction. Selling may involve delays, negotiation, or dealer markdowns. Guesswork over purity, must trust dealers' claims. Gold ETFs and trusts, for example, GLD, IAU. Pros: highly liquid, easy to buy-sell during market hours. Convenient, no physical handling or storage hassles. Broad vault exposure, gold held in several global vaults. Cons: management fees, erode returns over time. Unallocated gold risk. You may not own specific bars. Stock-like volatility. Gold miners, for example, Newmont, Barrick. Pros: potential for outsized returns. If a mine hits a big vein, your returns can dwarf gold's price moves. Income: some miners pay dividends. Stock market accessibility, easy to trade. Cons: company-specific risks, unpredictable management decisions, cost overruns, labor unrest, and exposure to unstable governments. Digital gold, for example, fintech apps offering gram-based gold. Pros: fractional ownership. Buy as little as 1 gram. Instant access. Buy-sell 24/7 from a phone. No physical burden, no vault, safe, or shipping required. Cons: counterparty risk. Platform failure may strand your assets. Lack of transparency. You may not know if it's backed one-to-one with real gold. Regulatory uncertainty. Varying oversight depending on jurisdiction. Each route wears a different mask. A bar might feel more real, but an ETF trades like a stock, and digital platforms bring their own dangers. Next, we'll pull back the curtain on physical gold's sneaky storage and tax traps. The tangible temptation and its hidden price. Holding a 1-ounce Krugerrand in your hand feels unbeatable until you realize your bank's safe deposit box costs $200 a year before insurance. Then there's the dealer markup. You might pay 3 to 5% over spot just to buy the thing, and when you finally sell, you face capital gains tax and plus another round of dealer fees. So your safe haven can end up costing thousands, just in upkeep. But if you hate lugging bars around, you could click buy on an ETF instead. though that convenience carries its own pitfalls. Up next, how a simple paper fund can sneak fees into your portfolio. When paper beats metal, or does it? Gold ETFs like SPDR Gold Shares, GLD, let you swap dollars for gold exposure in seconds. There's no vault to visit and you dodge storage bills. But every year you pay a 0.4 to 0.5% fee, which slowly eats into returns. Worse, not all ETFs hold allocated physical gold. Some use unallocated or even paper contracts. If markets freeze up, the fund might struggle to deliver real metal when you sell. And that brings us to mining stocks. If pure gold feels too dull, mining companies can crank out bigger gains. But they also come with corporate drama. We'll dig into that next. High-risk, high-reward mining stocks can hand you 2x or 3x the upside if they strike a rich deposit, but they also crash harder when things go south. Think operational missteps, rising extraction costs, or political upheaval in remote regions. And digital gold platforms? They promise fractional ownership stored in secure vaults. But if the platform collapses or gets hacked, your gold might disappear with it. You must verify that your digital holdings are backed by independently audited, allocated gold and read every fine print clause. By now, you've seen that owning gold isn't a simple buy and forget. So how should you actually use it in your portfolio? Keep watching because the final section will reveal the sweet spot that pros swear by. Gold shines brightest, not as your main growth engine, but as a shock absorber when markets melt down. A modest slice, often 5 to 10% of your total portfolio, can dampen volatility, hedge inflation, and give you peace of mind. But too much gold can drag your returns in bull markets. Too little and you lose the safety cushion you paid for. The key is aligning gold's role with your goals. Preservation over appreciation. Stability over excitement. So if you're building a diversified plan, consider mixing a bit of physical metal, a dash of ETFs, or even a contrarian miner's stake. Just don't let shiny temptation blind you to the trade-offs. At the end of the day, gold can be a good investment, but only when it's the right fit for your personal financial journey.